In your opinion, based on that bounce that we saw yesterday, are those comments, are those basically that pivot that everybody's been looking for?
I think it's not quite yet. So, he clearly was very, as they always are, Fed chairman, measured in his speech. So he said, moderate the pace. So I think that at least gave people confidence that you're just going to see, as I should put in air quotes, just a half a percentage point here in December. And then I think the market at least is thinking that you're going to move then down again to just 0.25% in February and another 0.25% in March, and we're done.
Interesting. So, know what else is pretty interesting? That those comments came just a day before today's PCE report. Comes out at 8:30 this morning. In general, I think the markets would take a softer than expected PCE, a better number. It's hard to say. It's like lower inflation, which is actually better. But lower inflation as a sign that the Fed might do exactly what Jerome Powell is suggesting. So is he trying to give the markets momentum? I mean, what was the motivation to come out and say this a day before the metric that we all know they're watching comes out?
Yeah, I'm not sure the timing was what he was looking for, but I think what he's trying to do is hope to get us to a soft landing in the economy. So you talked about it earlier. The yield curve, or many of the yield curves, are still inverted, which is one of the strongest signs we have that there's probably going to be a recession. So obviously, as chairman, he'd love to manage that soft landing. If he in fact gets some softer inflation numbers, it makes it, I'll say, more possible. It is certainly going to be a difficult chore.
All right, so I want to ask you about the question we really brought you on to talk about before we knew all this other stuff was going to happen, bond yields. Have we reached peak bond yields, and how do you think that today's PCE report will impact those yields?
So I kind of go at it, and I looked at it a bunch over history, and in one sense, I think we're asking the wrong question. So if you're an investor, what really is vexing you is that stocks and bonds are really moving in unison. You really saw it yesterday, right? So Powell comes out, says, more dovish things, bond prices move up, stock prices go ballistic, particularly in like the technology and the growth areas that have been, crushed due to higher yields. What I did is I went back and said, hey, whenever we go into a recession, do bond yields always fall? And then also, does inflation always come down? And the answer is actually surprisingly no on both counts. Now, most of the time it does. But again, the boogeyman really is inflation, if in fact inflation stays high. So it's really obviously hard to know if that inflation number stays high, but that's what you really have to key on, which is why, the number today remains extremely important.
Yeah, a lot of things are hard to know in this market these days, especially in the last month of this year. So much going on. We got PCE coming up today, CPI later, the Fed meeting later. So my question to you is, do you have a projection when it comes to bond yields? There was a time that we thought bond yields would top 5% possibly this year. Now that doesn't seem quite as likely. Where do you see them going?
I'm actually, if you make me pick, I'm going to say we end up going higher again. And the only reason I say that is, again, looking at history, when you've seen inflation CPI above 5%, when you've gone into a recession, you've still seen, generally speaking, the yields move higher still. They may not necessarily move a lot higher, but I just kind of look at the risk reward when we're building portfolios. That's really what we care about. So I'd be a little mindful of maybe not getting too excited about kind of trying to make money on the lower yields, because you're going to make plenty of money on the lower yields on the stock side. You saw it yesterday, right? And I think that's probably the key to when you're really putting together a portfolio.